Back to one of our top stories now, and that's these forecasts by ANZ that there'll be a 0.5% interest rate rise every month until Christmas. That'll bring the cash rate to 3.35%. We've come a long way since 0.1%. Mark Bouris, the Executive Chairman of Yellow Brick Road Home Loans, joins us now. Mark, is that your forecast?
No, look, it seems like we're getting hit up with a data storm and an opinion storm and a commentary storm from everyone across the board. No, it's not my forecast. And I'm probably more closely aligned to the CBA forecast and the Westpac forecast. So they both have come out more recently and indicated a 0.5% or 0.5% increase in the August meeting, which is a couple of weeks from now. Another 0.5% following that, and a 25 basis points increase by the end of the calendar year. So we're looking at 1.25 increase to take us up to 2.6%, which seems to be the market consensus, that the Reserve Bank would like to see the cash rate at around 2.6%, and then sit there and wait and see what happens sometime next year.
Is there a danger here? You go too hard now, you start putting too many brakes on.
Yeah, well, there is a danger of that, particularly when you consider that the cost of living has increased and is still increasing. We don't know by what amount, but it's still increasing. So that is why I think the Reserve Bank will, at the beginning of next year, February next year, have a look at what all the increases, including cost of living, etc., what effect it's had, to make sure that they don't overreach. Markets, commentators, and all the data sets that keep coming out and then we respond to tend to overreach in every respect. So we probably overreached during the COVID period when we reduced rates to 0.1. The cash rate I'm talking about. So we're probably going to overreach. Markets will overreach when we push rates up to where some commentators are sort of saying now, and I heard in one of your previous interviews there, where I think it's ANZ is saying that they're looking at 0.5% every month between here and the end of the year. That will have an horrendous impact on the mortgage market and people's ability to pay their mortgages, and it will cause an amazing contraction of spending in the economy. So much so, I think, Pete, that probably sometime next year, if that's exactly what happens, sometime next year we're going to have to start bringing interest rates back. We're going to have to start reducing
recession,
which sort of makes a bit of a mockery of the process.
Is that when we get into recession territory?
Potentially, or at least they'll start to reduce interest rates to make sure we don't go to a recession period. And I guess that sort of leads us to that whole conversation. We need a review of where inflation should be sitting from the Reserve Bank's point of view, so that they know how to react and not react, or overreact or underreact to where interest rates should be. Inflation's a big deal now.
Sorry, Mark. Even if we do get to 2.6 by the end of the year, from where we are, that's getting close to another grand a month that homeowners and business owners too, who have had to borrow, have got to find. That's still a steep rise to come.
It is a steep rise, but there's been a paper recently put out by the Reserve Bank, it was only yesterday, I think, that one of the Reserve Bank people, Ms. Bullock, who's talked about the resilience of our mortgage market, our economy. In other words, she's someone who's addressing risk and what they call shock to market sectors. And she was looking at the whole mortgage sector. And it was quite interesting when she described how resilient our mortgage sector is in terms of the prepayments they made over the last few years, increased equity in house prices, notwithstanding house prices are coming off a bit at the moment, but the increased equity that people hold in their mortgage, the amount of money people have added to their redraw and or offset account as a result of constraints on spending and, all the low interest rates over the last few periods. So she's sort of indicating to us that we have amazing amount of resilience and sort of backup sitting in our mortgage market. There are sectors where there will be a problem. So all those people who borrowed fixed rates over the last 2 years, who have borrowed up to 90%, maybe they're going to be affected. But generally speaking, and we can only talk in generalisations, averages across the whole board, she's sort of suggesting we are very resilient in our marketplace, which, by the way, is a worry. Because if the Reserve Bank thinks we have plenty of capacity to withstand interest rate rises, then there's nothing really holding them back from really going hard on where the interest rate rises should end up. Wow. That's a worry.
There is a lot of moving parts at the moment. Mark Bouris, always good to have you with us, though. Thank you. We'll talk to you again soon.